The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. As we take a look at the trade action we saw on Wednesday, mostly lower across the grain and oilseed trade, led down by those wheat markets. We have plenty to take a look at, a lot of outside market nervousness, it felt like, on the day. Joining us here to discuss, our good friend Mike Zuzolo with Global Commodity Analytics. And Mike, good to have you back on the show here today, sir. Hope things are going well in your neck of the woods.
Doing great, Jesse. Looks like we're going to miss a lot of the precip, though, so that might be an issue maybe midweek next week, about a week from now. If the hard red wheat belt misses a lot of the precip that the trade's thinking about, probably be something to be looking at.
Definitely. Well, and some of that moisture that is in the forecast for Texas, Oklahoma, felt like maybe that was some of what was blamed for the drop in the wheat market on the day. But I know a lot of those outside market worries. Did you feel like the moves in grains Wednesday, just for us to start here, was it more technical in nature, do you think, Mike?
Yeah, I mean, I think where we were at was we needed to see the momentum indicators remain strong because we had hit some technical resistance levels, as you say. And this comes off the heels of last Friday before the holiday, where not only did we hear that Ukraine was still down about 30% on their shipments year to date in grain exports for their 22-23 marketing year, but more importantly, the Rosario Grain Exchange came out and said essentially this spring into early summer, Argentina's corn exports were likely to be down 40%. That's not a surprise to me, but I think the trade's finally starting to realize that there's going to be a limited amount of corn out there. And so once we had that information out, we came back from the holiday weekend thinking that maybe we'd be able to build upon that. But I think that's where the outside markets caught us again. We got back into a risk-off deflationary mindset. And once again, we see the same pattern that we've seen, Jesse, crude-led, wheat-led break to the downside. And now we're just pennies away from the hard red wheat January lows, and we're only less than $2 away from the crude oil February lows. So this same pattern you and I've talked about still hanging in there, fighting us as we try and find some short covering rallies.
Well, you brought up the crude market, and I think we're going to start there and dive in a little bit more. I just want to talk a little bit more about that and how that ties in with wheat here. And I'll pull up the wheat chart you sent me here on the video feed. And I know Paris milling futures, they've been under some pressure. But as you look at that relationship between crude oil, wheat, leaders to the downside, could you talk about some of that relationship a little bit, Mike?
Yeah, I mean, this risk-off atmosphere we have this week is twofold. Not only did we get the Federal Reserve minutes out right before you and I went on air here on Wednesday afternoon, and that shocked the market and made the dollar want to become a safe haven asset, but we also saw that this issue between the United States and this new trading economic geopolitical bloc between the Russia and the China butting up with one another as the United States and NATO try and make headway and support the Ukrainians more, it's really starting to impact our commodity markets. And wheat is the canary in the coal mine. It's the risk-off mindset that leads the market. Because why? Well, for instance, today, this EU milling wheat futures price getting back down to an equivalent of 812 takes you past all of the 2023 lows at this stage. And with EU milling wheat in a closer proximity to the Middle East and other key importing countries, if Russia doesn't get the business, you would think the EU would get the business and France would get the business, Germany would get the business. But if the EU market's going down, it's going to be extremely hard for us to see anything but a lower market price action. And so geopolitics, fundamentals, Federal Reserve, all adding to the idea with along the lines that the Russian ruble made a new 10-month low as we got ready to put on new sanctions against Russia in both the United States and NATO. All these things work in favor of Russia getting more business. And I'll have to say it right here, right now, Jesse. I think Russia and China and this new East mindset that we've talked about periodically, they are coming closer together, and I do not think they're going to back down. I think China is in it to win it when it comes to supporting Russia because they see a change in the geopolitical structure of this market, and I think they do see the United States as weak as possible at this point, and Russia needing to be as strong as possible at this point.
Mike, you mentioned China. I'll pull up another chart on the video feed, and I'd love for you to walk us through this chart and just expand upon some of the thoughts you just shared there with the Russia-China relationship and just how China and their yuan compared to our U.S. dollar, how all of this is working together right now.
Yeah, this is a really nice chart because it kind of shows the U.S. dollar against the offshore China yuan. And when that price is going up, that means the yuan's losing to the U.S. dollar. And so you see now we're at a new 7-week low in the Chinese currency against the U.S. dollar after having come off a major support line, both in terms of a flat support line in red and then the green uptrending support line that's founded upon the 2022 lows. And so we really technically have tested the support lines in the dollar, and those support lines held. And now we've got this, and this is where your technicals come in, I think, Jesse. Now you've got fundamentals that support this technical bounce in the US dollar against the Chinese currency. So if the Chinese currency is weakening against the US dollar, why wouldn't they buy commodities? Just from a currency standpoint, their buying power is better than the US. And when you have the geopolitics, it's easier for them to buy from other countries, i.e. Russia. And that's the rub right now is we've got super tight supplies in the world, but the two countries that matter most, China on the buy side and Russia on the sell side, still seem to be in control of this market.
Well, super tight supplies and watching Russia and China and how they're controlling things on those sides, as you mentioned, is one of the big things we're keeping our eye on now. But I think another thing on the horizon here, Mike, we need to talk about and how this could potentially impact the market is acreage, baseline acreage projections. I'll pull this table up on the video feed. Let's talk about this a little bit because I'm starting to hear more and more chatter about what our acreage could look like here, this year, next year, beyond. So walk us through this. What are your thoughts of where things stand right now?
Yeah, the reason we wanted to talk about this today is so that the listener and the viewer could understand that the baseline numbers we're looking at right now will change this week, and the new 2-day meeting from USDA in Washington D.C. starts tomorrow on Thursday. And so we'll be drinking more fundamental information through a fire hose at this point. And so it's good to look at these numbers before all the new information comes out. And what I find striking about this chart is when you look at the total planted acres across all the major 8 crops, you notice that we hit a high of 253.4 in 21. We went below 250 million acres this past year, but USDA has us up above 250 the next 2 years, and then below 250 for the rest of the baseline projections. And these were you can see down at the bottom in the note that the USDA last updated these in September of 2022. So I'm very dubious of a corn planted acreage of 92 million acres. If they come out this week with 92, I think that really unravels some of the strength that the corn has had in this market, especially the new crop corn. And so it's something I'm very, very nervous about. I personally think that we're going to be below 91 million acres just because the fertilizer prices, while they've come down, they're still much higher than the 5-year average. And we still have a lot of high prices when it comes to crop insurance and especially interest rates just keep going up and up and up for the 2 and 5-year money.
Something I noticed on this chart as well, when you look at soybeans, you look at some of the fluctuations in corn, yet soybeans 87 million, 87 million, 87 million, like pretty much across the board. I find that very interesting as well, Mike.
Yeah, exactly. And this is where they do projections and they just do a flow. And I'm not sure how they come up with that. But here again in 2023, we know the wheat acreage base is going to be up. USDA shows some of that, but we have to remember all the soft red wheat acres that we saw coming in. And I don't think those numbers are balanced into this table, or it's as up to date as it should be, because that soft red wheat acreage base that's harvested in June, July will go into probably double crop beans, and the acreage base that's been planted in soft red wheat came off of bean stubble. And so that takes away from your corn acreage base. So again, I would say we need to really be critical of these numbers, but it's good to see them a day or two before we get fresh ones.
And also, how does CRP play into this whole equation? I think that's another thing to consider here as well, Mike.
This is everything when it comes to getting above 250 million acres planted, just dovetailing what you and I just talked about, and the cotton issue. A lot of the South didn't get planted because of the terrible drought, or because some areas had too much rain last year. It looks like the drought's ending in that area, and they may be able to get more of their traditional crops planted. But this is where the rubber hits the road. How can we stay above 250 million acres the next 2 years? That red arrow is right where 2023 is. We're going to be increasing pretty sharply, actually, the CRP projected acres on the program, and get above 25 million, get into the 26, 27 million acreage base of CRP again, heading into 2024 and through 2025. So it really makes me wonder, how can we see bigger planted acres when the CRP is increasing 5 to 7 million acres since 2021?
Well, we're having a conversation today with Mike Zuzolo of Global Commodity Analytics. He is our guest analyst here on Market Talk. And Mike, just to kind of wrap up our grain and oilseed conversation here real quick, again, I want to bring this a little bit back to some risk management thoughts here. Obviously, producers see a down day, a big red down day like they did on Wednesday, might get a little nervous. But, just the general trend of this market lately is we're waiting on, it feels like, a big news item to move us one way or another. So it's no reason to panic with a 1 day move, right?
No, not at all, especially with the new information coming out here. And we haven't closed this week out yet. I do put a lot of importance on the weekly close, however, not so much in cattle, because we'll get a cattle on feed report after Friday's close. But I think in the grains, the weekly close is pretty important at this point, Jesse, because we did bounce off the upper end, those technicals that you're talking about. We couldn't go through it on the momentum side of the equation. And we also are seeing, in terms of beans, the leader to the upside, the market has properly and correctly put a lot more premium into the beans again. We were trading upwards of $15.50 in the front end. We tested that $14 level in the November. Those are numbers that I wanted to test again. And so now those needs have been met. And now we also hear that we've got Brazil planting starting to pick up steam. Mato Grosso soybean harvest at 60% now. Second crop corn planting as a whole at 33%. In Mato Grosso, it jumped 18% to now 50% as of last Friday. So we are making headway, and those rains are not impacting us as negatively. So we do want to be cautious about overstaying our welcome and letting the bean market, try and trade higher. I would continue to watch the spreads and the meal. And I'm very eager. I told clients and subscribers this again this morning. I'm very eager to get 100% insured bushels sold in 23 soybeans because of what's happening between China and the United States.
Let's talk livestock. Let's talk cattle, Mike. The cattle market on the day Wednesday had a fairly decent, okay day to the upside. Some things to watch here, though. And I'm going to pull up a chart on the video feed. Just love for you to walk us through what you're seeing on this continuation chart for April, and just your general thoughts on this live cattle trade to start.
Yeah, this is only April futures, does not show any other contract. And so it's a very clean chart for the spring, those second quarter marketings. And keep in mind, USDA just updated us on the livestock, dairy, poultry numbers this past week, about 6 days ago, and said for quarter two, we're looking at $159 average prices. So now April is a good $6 above that. So to me, between that and my overvalue level of 164.75, which I increased about $2 in the aftermath of the cattle inventory report at the end of January, I really think we're back in that red zone again. And notice that the fat cattle are upwards of where we were in 2014 and 2015, while the feeders are still about $30 below those price levels. And I put that at the feet of the corn. But we've got the premium now in this cattle market heading into the cattle on feed report Friday afternoon.
Now, as we think about that cattle on feed report coming up, one has to assume we're going to see a continued tightening or at least a status quo of what the herd size is looking like, et cetera, et cetera. Do you anticipate any major moves in that cattle on feed report coming up on Friday?
I think the trade is, Jesse, I'm a little bit nervous about us building in too much of a bullish premium because all three numbers, marketing's average 103.9. How did we do that well when our slaughter's been down? I know it's been down more in February than maybe in January, but I'm still very nervous about the marketing's number being almost 104%. On feed at 96.5%, placed in January, or on feed as of January 1, 96.5, placed 97.1. All these numbers very low. I think they're below 100%, but I probably wouldn't be much below 100% for the on feed. I still think that we are probably not as current in the cattle in the pens as maybe what the trade is thinking we are. And so I hope I'm wrong, because I think we've built in a bullish scenario for the cattle on feed report. And I think we really do have to start thinking about consumption, because Home Depot, Walmart, Kraft, all these major food and consumption related companies are giving us a warning sign that later this year things are going to tighten up. And I think especially in the beef trade, that's going to be the case.
Talk of possible mad cow cases in Brazil on the news wires on Wednesday morning. Are you worried about that? Watching that? Have you heard anything else when it comes to that here and how it could impact the cattle market?
Yeah, not so much. Two things on that. I think that this mad cow situation, if it expands, we want to see, does China stop importing beef from Brazil again, like they did 1 or 2 years ago? I'm inclined to think they won't do it this time, because I'm inclined to think they'll keep buying from Russia and Brazil so they don't have to buy as much from us in case conditions get worse politically. The second thing kind of related to that, does that curb then the Brazilian imports, or I should say exports, coming into the United States that the United States buys, or maybe Mexico buys from Brazil? Does that change any of the dynamic of what Brazil ships out? And maybe can we pick up some extra export demand, or maybe it cuts back on our imports and gives us a little bit higher prices if it does get worse? So those are two things I'm looking at right now.
Okay, good things to think about. Hog market lower on Wednesday, and I wasn't surprised, I guess, because I know Tuesday we saw cutouts drop, and it seems like we have that relationship. If cutouts drop, the next day the futures board drops, or if cutouts go higher, the next day the futures board goes higher. Is that the best way to sum that up, or what are you seeing in this hog trade?
I really think it is. I don't think it gets any more complex than that until we see those fresh commitment of traders numbers, because I think the funds really do trade heavily, not just on the cash, not just on the pork export sales, but also on the commitment of traders report. And until we see fresh commitment of traders report and we see that we're cutting back on our cold storage inventories, I do think we're range bound. I think that $90 level is going to probably be a price cap in the futures, because the cash market, while I think it's picking up some extra consumption, as we've talked about, probably difficult to get much above 90. I would not be a seller in hogs, though, Jesse, at this point, because the cutout has been supportive. And we also are going into a more positive seasonal as we get into springtime. So I'd make this market get it to at least 90 in the April or May futures, and maybe even above 90 before I'd be a hedger again.
Fantastic stuff as always, Mike. Before we wrap it up today, any final thoughts you have for us?
I think we're really truly at a time between the grain deal expiring on March 18th and the first wheat crop conditions reports coming out for key states like Oklahoma and Kansas next week, and what's going on with Russia and China, and what's going on with this baseline projections report. I don't see how it could be a bad idea at all to sign up for a trial at globalcomresearch.com, because you'll get a lot of information compared to what maybe we would get in midsummer. So please do that and see if you like our analysis.
Globalcomresearch.com is how you can find out more information. That's com with 2 M's, globalcomresearch.com. Always a pleasure. Mike Zuzolo, Global Commodity Analytics. Thanks for joining us, sir. We'll talk to you again soon.
Okay, Jesse, thanks for having me.
And that's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.